Hi, this is Randy Finney with Right Side of the Chart, and this is a mid-session update for what are we at? Friday. Sorry, getting lost track of the days with the holidays. It is Friday, January 2nd, 2026. So I just want to start off by wishing everybody a very happy, healthy, and prosperous New Year. What I'm going to do in this video, I am about to leave town, and I'm scrambling to get out of here. I'm already behind schedule a little bit. Saw a handful of chart requests, so I'm going to wrap those, include this in the video. So here's what I'm going to do. I'll do it in this, I'll try to stick to it in roughly this order so you can skip ahead. I'll start out, as I often do, with the equity markets. Somebody asked for an update on the VIX, which I plan to cover anyway, so I'm going to throw that in there with that. Then just let's see if I can keep it in order. There's a few trade ideas. I had a friend reach out today, asked me for an update on RKLB, or my thoughts on RKLB. It's a nice looking chart. I'll share that. Mike on the site, somebody asked about, I think it was Mike Carvana, CVNA. Been posting quite a few updates on that, and there's a trade idea as well. And so I'm going to cover Carvana. Definitely want to hit on, just speak to gold, silver, GDX. You guys have had quite a few frequent updates recently, so I'm not going to spend too much time there. You have those charts on the homepage, including the most recent ones today. And then Treasury bonds briefly, because interest rates very much do matter, in my opinion. They always have, and I believe always will. On a related note, BIZD, those are the private credit business development companies. And then finally, I want to just squeeze Bitcoin in there because we took out that minor downtrend line, and I'll give you some thoughts there. All right, starting out, QQQ. This is a weekly chart. Most important for the kind of the bigger picture, not where the market's going to go today, tomorrow, in the next hour or so, but where the market's likely going in the coming months. That's what the weekly chart will help forecast, if you will, or predict. Divergences and developments such as trend lines. These are developments. You have uptrend lines. You have trading ranges or development. I'm not highlighting one here. Divergences, overbought conditions. Those all form, especially the developments like trend lines and divergences on the weekly charts, typically over a span of years. You can see my year break lines here. So again, we use this, or I do, to kind of figure out where things are going in the longer term, in the coming months to years. That's the time frame I will trade off of when trading on the weekly charts. And you've had for a long time these price targets I gave you, really starting last year, and we hit there were a total of, these are the same longer term targets here. We hit T3 on the April lows after Trump's liquidation day. There was that bear flag measured target. We just slightly overshot that. The purple line right here, BFMT, that's bear flag measured target, purple line. And it was my third target laid out back then. So what we did is we made a new and a marginal. When I say marginal, it's relative to the scope. If you look at, this is your bull market here. Again, remember, when I say marginal and I'm analyzing, speaking to, you have to realize what time frame you're speaking on. So we've been in this is the real bull market. These, although they're technically bear markets by the old antiquated definition of a 20% drop off the highs, COVID and a couple along the way, including that last one, 2022, or right here, 2022. They are really just corrections. Again, the Fed has supersized things in recent years with massive liquidity injections. So the market tends to have more powerful uptrends, and the corrections, again, you can look at this again if you want to use semantics, really, whether that's a bear market or correction. When I look at this, I see in the last couple decades two bear markets. This one doesn't look like much, but it was a 55% drop in both the NASDAQ and the S&P 500. This one happened to be almost an 80% drop in the NASDAQ. That's the dot-com bubble. That's the financial crisis. And again, you can see what the amount of liquidity injected in the market. So we've still had these, again, to me, corrections. And so we haven't had, in my opinion, a true bear market since the financial crisis. Bear market that's going to go on a year and a half and measure in 50%, around a 50% drop minimum. And those are my targets. So Nothing's changed. Nothing's changed in the technicals. As I often say, if in life patience is a virtue, it's an absolute necessity in trading. Now that doesn't mean that if you shorted here, on the first sell right here, and you hit that T3 level, or you shorted here, that you should still be short. I use the daily and 60-minute charts as my guide in out, and we've had many, many long reversal points, cover all short points, and go long. And so, again, this is just formulating the bigger picture. Now to zoom in to the shorter term, more recently we had multiple sell signals. We had them on the daily and the weekly. This is the weekly chart. There's our bearish engulfing candle. We had one there as well, and then a second one right there. And so far that one has marked the top. We haven't taken it out. And this was also a breakdown of the primary trend line and a back test. And there's that key October 10th. Where is it? We'll go to the daily chart. This is a level that I still think needs to go. It's the October 10th low. Been harping on it for a long time, ever since really shortly after we put it in. We tested it there in November, and the S&P also hit it there. And it was also my first target from, again, this we had sell signal 1, breakdown, back test. We had multiple sell signals on various time frames, including what I just showed you on the weekly. So, and since then, the market's gone absolutely nowhere. So if you are in that group of people who are very frustrated, number one, because you're only trading the indexes. If you go back, and I encourage you to do so, especially if you're new to the site, we've had numerous trade ideas, and the vast majority, they're not all winners, they never are anywhere, but we've had probably more, I would say well over more winners, batting well over 500. And we've had as many successful short trades probably as longs, very close. I always try to put a mix, an eclectic mix of long, short trades in various sectors, various stocks, even different asset classes, commodities, bonds, crypto. And so, again, that's where the money's been made. When the market goes sideways, the only people that make money are successful stock pickers or those that are willing to go and trade other things such as commodities, bonds, fixed income, crypto, and other things like that. But if you're only an equity trader, or if you only like to trade the market, there's a saying, you can't squeeze blood from a stone, water from a rock, however you want to say it. I think the Brits say blood from a stone, Americans say water from a rock. Same kind of thing. You can only extract so much unless you're actively swing trading. But again, that's it. So we've gone, stock market's gone nowhere in months. In fact, it's trading today, the NASDAQ 100, where it was trading back in October before that sell signal triggered. So we're right back to where we started there. All right, that's it. And nothing has changed. This is as I mentioned today in the first post I got out to you, and the only one before this. This was, I forget, you'll have to reference, the entry point was somewhere over here. We hit my first target, we bounced, and we've gone sideways. That's just what I consider a typical and likely reaction off the initial tag of a price target. Again, the initial tag, once you hit it, doesn't mean you can't bounce again. It is still very much support. In fact, it's a support level I've been harping on again for months. The October 10th lows, that's 589. Need to take that out. That's why it was set there as a target. That's why there was likely to be a reaction. And now we need to take it out. And then T2 is down here. T2 is going to take you back if it happens soon. What I mean by that, if it doesn't happen soon, the market goes higher first and then we go down, well, these 200-day moving averages are going to keep moving up. That's the red line here and the blue line, 200 exponential and simple. But as of now, if there's let's say a drop in this month, in January, we're going to come in and the market would probably undercut the 200 exponential there and hit that T2, which is price support, which comes in right now with the 200 simple. And that would just be a correction, right? Nothing huge. It would be from the recent, well, we'll just measure it from where we're at right now. If it happens soon, it's going to be about a 9% drop. Certainly something very profitable for a swing trader. If you can make 9% in a month, annualize that out, and you're doing very well. And that's what swing trading is all about. We try to capture these ins and outs. So whether there's a big trend, whether it's bullish or bearish, there's always counter trends in there. And again, the 60-minute chart tries to get you in a little quicker. 60 minutes a bit of a mess right now. This is my 60-minute, obviously a busy board, but that was a divergent high, multiple sell signals there. divergent low. And again, this is my go-to swing trading time frame. So most recently, we put in a divergent high there, and that's marked it. We had a first drop, kickback rally, and that's my current expectation right there. And that is based on both this and those longer term charts that I start with daily and weekly. The S&P matters. I don't trade it that often. The only time I'm going to trade ES, the S&P 500 futures over NQ, is when I think the financials are about to get hammered. That's because other than that, the S&P is grandma's index. It has a lot of utilities, steady eddy, defensive issue stocks. And so it goes in the same direction over time. It always will move up and down with the NASDAQ, but in just a lower multiple. It's the same logic or reason I'll analyze gold. Gold's going to determine where the precious metals go, but my money typically is on silver or GDX because they move in the same direction, but a multiple thereof gold. So same story there. And so this is the S&P. The story of that is this big, this is a more accurate measure of the stock market locked in a sideways trading range. We had a divergent high there, then a sell signal breakdown back test, bounced off that October 10th low. Again, that's the key level. So have price alerts there. I will be back at my desk. I'm coming back this weekend. I'll be gone for the rest of the day today, but this isn't going to happen today. But if it happens, whether it's this month or 3 months from now, if we continue on this trading range or if we pop the trading range, it's a breakout that I predict will fail, just like I did back here. I recognize the same exact thing back here at the time. If you look at the coverage back then, we were in an almost identical trading range. I said any marginal new high will be a divergent high with overbought conditions, and as such has my preference would be, or expectation, that breakout will fail. And it did, and it failed. You went back to the bottom of the range, then you broke the bottom of the range, then you back tested the bottom of the range and the 200 days. See, it's all together. You got the 200 days right here, the bottom of the range, and when the market saw that it couldn't regain the 200s in the bottom of that range, boom, that's what happened. So that's it. And some will say, oh, that's because of Trump stepping up the podium. Well, we had a prediction I made. I gave you the market will, I forget the terminology I use, but lights out, I think is the term I use. If it broke a support level, I give it to you on the futures. And that was a day, and it broke before he even stepped up, or right when he stepped up the podium. And then we got the rest of that drop. All right, so that's that, guys. I just want to point out the similarities, and there are no guarantees in this game we call trading. But as I like to say, history doesn't always repeat, but it often rhymes, and that's what we do. That's what technical analysis is all about. So we have the same kind of technical setup, and we're at the top of the range. And if you want to keep it very, very simple and just have a mechanical approach, when you recognize a trading range, you short or sell your longs at the top of the range, and then you cover your shorts and or go long at the bottom. And here we are at the top of the range. So again, whether we pop it, and if we pop it, guys, one strategy, if you want to be the second mouse that gets to cheese, wait for the breakout to fail. There's nothing that says we can't pop that and burn through these divergences, meaning we take out the higher highs, the previous highs. But that's the safe bet. Wait, if we do break out, for a failure back below, just like we did there. It was an ever so slight marginal breakout. It failed, and then that's all she wrote. So that is my current expectation. If something more than that happens, then I will cover it at the time. All right, let's move on and talk. Well, we'll go to the smallies real quick. IWM, same thing. We had a breakout that just failed. Whether or not we closed on a weekly, I've been kind of last couple weeks just in and out. Told you not trading much. That's still, I'll maintain these targets whether or not you went with a suggested stop on a weekly close there. I think it was a slight close, one of those in the last week or two when we had, again, I talked about my preference to widen stops on positions that I have during the holiday season, and take any breakouts or breakdowns, even if they're a buy signal or sell signal, with a big grain of salt, because you get that low volume holiday trading. You can see volumes were non-existent. A lot of people like myself are on vacation. Even though I didn't travel this year, I just didn't sit in front of my desk. It's just not worth it. I've done this long enough that, unless I see a lot forming, a lot going on there, I'm just going to keep things light. So that's that. And there's outlook is still the same. There's your next targets on. Remember, this was just a bounce off T1. We put in a divergent high, breakdown back test on the small caps, put in a marginal noon, still divergent high. And so nothing's changed again on my outlook or expectation. But remember, this is just one of many trades. So we're going to get to the rest of them right now. We're going to go to the VIX since I'm on the stock market. Somebody asked about that. So on one hand, we did take out that uptrend line. So for a while here, highlighting this uptrend line, we've been buying pullbacks to it. We've also gone long on all these divergent lows, traded all these pops. We haven't missed one of them yet. Even that last one doesn't look like a lot, but it was a 100% gain from where I posted the entry on September 12th. And that was a divergent low. So it's wash, rinse, repeat. The same technical, conditions that work on trading a stock or crude oil or natural gas, which, I need to scratch that down on my notepad. Somebody asked me about nat gas. I'm going to get to those. They work just as well in the VIX. And the VIX is basically going to move inversely to the stock market, especially during the big corrections. That's when the VIX wakes up. So what I can tell you is if we want to be a glass half full on the stock market, guy or gal, you can say, well, the VIX took out that trend line right there, right? Broke that trend line. And if I said recently, if it did break that trend line, we'd probably drop down to the next support level. You can say I have minor support there and a much more significant support zone down here. And so that would say, okay, that's bullish for equities. And we're currently back testing. So I'm going to acknowledge that. If the VIX can't pop and regain that trend line, then yeah, there's a good chance that stock market can rally in January and we're going to drop down there. However, if we do gain that trend line, then this is what we call a whipsaw, aka bull trap, again, to the stock market. Remember, put the VIX in reverse. To be bullish the VIX is to be bearish equities. So, and as I often say, fewer things in trading are more bullish than a failed breakout. So bullish for the VIX. So that was a breakdown below the trend line. If we recover it, you're going to have those that shorted the VIX that's where their stop is going to be, somewhere back above that trend line. And then you have a price resistance level here at 1720. A very nice level. That's where I think the VIX is going to start to let loose and give us our next big up, and the market will correct and hit those price targets I'm talking about. That is my preferred scenario. Again, you can wait till it happens. You can go long right now, because if you look at it this way down here, remember, this was a divergent low. The VIX went up 100% from there, or highlighted. What do we have now? Even bigger divergence. So it's the same song I've been singing on the stock market. We have that same divergence. We've had it for months now. I know some are probably tired of hearing that. Some think, and look, it doesn't work 100% of the time, but I would say it works 80+% of the time when I recognize these kind of setups with the divergent highs. They just, it's typically that third, not always, but usually when you're building multi-month divergence, you get the first one, you get a correction, second divergent high, you go a little higher, market get a little bigger correction, and then it's usually the third one that's the charm. We'll see. Either way, that's all I can tell you definitively. This is not subjective. This is factual. This is a big divergent low, aka positive or bullish divergence for the VIX. And typically, again, not always, but generally, the bigger the divergence, the bigger the ensuing move. So I had given you targets before. The same targets that we had here. This is the big level here. We get up there. If we're going to enter a real bear market in 2026, we're going to take that out most likely. This has just been where corrections have stopped in the last couple of years. That spike to that level in the VIX there. So there's your update on the VIX. You can trade VIXY. There's a lot of VIX tracking ETNs and ETFs. And look, this one's going to suffer from decay. That's why me personally, I like futures. These especially leveraged, even though this one is not leveraged, it's almost the same net effect for two reasons. The volatility in the VIX is so high. You get day-to-day swings that are very high. You're going to get decay. And more so, this thing has expenses like any ETF, but they're also rolling futures. And that just, it's the probably the worst buy and hold vehicle out there. You got to hit and run. And these were the targets I gave you before. With that divergent low, we did hit the first target. We drifted back down. and this has fallen more than the VIX, but it does have that positive divergence. There's a little trend line I just gave you there that could do the trick. But again, you want to use a spot VIX or VIX future, which are right here. This is VIX, the January contract. We've got a couple more weeks left on these, a few more weeks. There's your nice looking setup here. Let me extend. I told you I've been away from my desk, so I'll just have to extend the divergence. As long as it's still there, it just indicates, you know, a bigger move. Once it pops, there's a nice, well, fairly nice. I like to see 3 clean reactions to validate a trend line. Right now I only have 2, but I think that'll do the trick. More so, there's your BOD or benefit of the doubt level. You can see 2 resistance levels I have on the VIX futures, about 1670 and about 1710. I think they will let loose on a break of 1710, go up here. I'm going to measure that out for kicks and giggles for you right now. From the first breakout point, if I can grab, it's really hard to do on this platform because you move all the other lines, but let's do it this way. So let's just say we pop this and we have a little kickback rally. That's 16% right there in VIX futures. But again, here's the thing. Here's the way I analyze the markets. If this happens, that means the stock market's going to correct. We're going to then go down and break some next support levels. It's going to help confirm those divergences that are in place. And I think it has the potential to be a catalyst for a much larger drop. And then I would turn my focus. This is only an hourly chart. Then I would turn my focus to the longer term charts or that spot VIX like I just gave you. Those are the 2 that I analyze for tracking purposes. Again, you might want to trade VIXY or there's a bunch of them out there, but for charting purposes, spot VIX and the VIX futures are what you want to cue in on to see if the VIX is broken out or when to take profits at your preferred price target or targets. Okay, I'm not going to spend a lot of time on gold. Last week I got these charts out to you, and then I followed up. As I often recommend, if you're new to the site especially, if you're interested in any post or even not the topic in that post, sometimes other topics will get posted in the comment section below. But last week after I gave you, when we put in these island tops in gold and silver, I also posted the charts of the futures for you. And I give you updated charts there as well. I'm using right now my preferred charts on the futures are the 120-minute candles, meaning I call it a 2-hour chart. But and as I told you today, gold has taken out this trend line on the daily, which to me was what triggered the next add-on. You can take it to a full position, or if you want to play it safe, because this is all holiday breakdowns, so you have to take them with a little bit of a grain of salt. But however, now the holidays are over. Today's the 2nd of January, but the first trading day of the year. Traders are starting to come back in, and as of now, gold's below there. If gold takes that back, something else is going on, and it just has that voracious bid. But right now, this is, I want to repeat, as I said today, I think one of the best trade ideas right now. Everybody, and when I say everybody, I'm not speaking literally, I'm speaking, metaphorically, but I do read a lot of forums and headlines, and just everybody and their brothers just so foaming at the mouth bullish on gold and especially silver. It just reeks of not just, remember last time we shorted gold here. We shorted gold, GDX, silver. What made the quick bucks was the biggest drop in years, I think. But back then, that was just a correction. I didn't have the evidence in the chart. Now I have this big negative divergence, divergent high. I have what is clearly all the makings, and we'll see, only time will tell, of a blow-off top. Silver's gone parabolic. You have to look at it, from a longer term perspective. I'm using log scaling. That is a parabolic advance. Means I cannot draw. I have to draw a series of uptrend lines because I don't have a parabola tool here. I have it on other charting platforms, but that's what that is. And as I've often said, I've been doing this for a very long time, and I can tell you that parabolic uptrends usually don't end very well. And by that, I mean they come down pretty hard. So now look, on the weekly, we're still above. This is your current uptrend line, probably right here is a tight fit. So it's possible we get a stick save if you're trading off the weekly time frame. If silver can maintain above this uptrend line, then yeah, maybe we continue to go. And this is what the daily is right here. So we broke down on, that's the New Year's candle right there. Remember, we were closed New Year's Day yesterday. So we did have the sell signals looking for there and gold. So that is that. Again, take it with a grain of salt, but you can also take it on face value. Breakdown's a breakdown. I guess if you listen to my voice, it just may not be that all-in moment, like I said, until gold takes out Wednesday's low. But right now, treat it for what it is. You have a cluster of candles right there. You have the trend line break, most importantly, and we're below it. And then that high-level bearish PPO crossover is about almost effective. If I have to squint to see it, the lines are testing right now. Sometimes they kiss, meaning the PPO line, the blue line above. Sometimes you'll see in an uptrend the lines kiss and do that, but typically those crossovers, and again, that's the last time we shorted silver, was right there on that. We had a divergent high as well, a little wedge break, and it doesn't look like much, but again, silver fell in very short order, about 16%. Enough to most likely shake out a lot of weak-handed longs, but it ended with a divergent low. Then we had this run up, and there's that uptrend line on my 60-minute chart. We're below that as well. So I just want to show you all the different charts I'm watching. Breakdown, back test, rejection. This should be lights out if that gets taken out. That's my thoughts right now. That's how I plan to trade it. There's gold. I'm going to tweak this trend line just ever so slightly to just tighten it up, extend it a little bit. That trend line comes off the early November lows, very well defined. And again, as I said earlier, and on the futures, you almost have to squint to see it. Again, there's a lot of volatility, but what this green is, that was a breakout to new all-time highs. Remember, this was the previous high in gold, or multi-year highs, I believe, all-time highs. And this red means that breakout failed. We fell back below that level. So that in itself is bearish. However, really want to see us clearly get away from this uptrend line. Then that, to me, is the all-in moment. Now, what does all-in moment mean? To me, let me be very clear, because I know a lot of, some people listen to my voice are relatively new to trading. That doesn't mean all your money short gold or silver GDX. You'll get killed if it goes the other way, especially silver. All it means is whatever amount you want to allocate to precious metals, and that's different for everybody. So if you have a portfolio, I'm a big fan of diversification, asset allocation, even in a trading account. So you might say, well, I want to be 20%. 30, 40, 50%, but not 100% of your portfolio. And that's where a full position would come in once that level gets taken out. So that's it. And then GDX, of course, like I said, silver and GDX, you get more bang for your buck. Last time we shorted somewhere right here. We hit 1, 2. The first target was the uptrend line. That was my first target back then. So we got ahead of it. We shorted before it even broke that first trend line. We shorted, I think, on this minor trend line, but I also, you know me, I always look at gold, silver, GDX, and the dollar all together, and they all go into, factor in. So that was the first target hit, second, third, and we reversed a hair shy of the fourth target was this price there, and put in that divergent low right there, positive divergent, gave us this new run up. And as I mentioned, if some of you might have held tight all along on a GDX short. It was a marginal, ever so slight, again, relative. GDX moves up and down 5, sometimes almost 10% a day. That's only about 7.5% above that previous high right there. And that's still the potential final target down here. And now we've come full circle. We have the very, very well-defined uptrend line on the 60, divergence line. That's negative divergence, gives us that rising wedge pattern. And just like gold and silver, it broke down. S1, I already gave you this chart last week. That's support 1. That's also the previous highs right there in GDX. So all this right here is the breakout to new highs above that previous high. We tested it, broke out. So a break of S1, meaning first support level, 84.19. Let's round down, call that 84. That's going to make this whole thing a failed breakout, this whole breakout here. And so these are still your targets, and that's still a potential final target if we can get some traction going on this one. And if not, that's what stops are for, my friends. I gave you very clear stops. If you shorted the sell signals that we had last week, your stops were above that recent high right there, that high from Friday the 26th. in both gold, silver, and or GDX too. I'm just covering these charts. All right, moving on. Let's go to kind of somebody asked again. I'm going over the comments, questions. Somebody asked about Carvana. On that, I'm going to go to the site here. There's VIX. As I already covered VIX, so I'll go home. And oh, I got logged out. All right, let me just go in case there's something new here since I started the video. A couple did the picks. Okay. Thank you for that, Bernadette. All right, let's go to previous one. Just want to cover everything, make sure I haven't missed anything before I leave town. Somebody asked about crude. If you're interested, here's my long-term chart of crude oil with some comments there. And go back. Comments. Carvana. All right, so did I forget the? Yes, I did. Sorry, Mike, I forgot. I was going to give you a link for Carvana. I'll do that right now. I'll show you how to do that. If you're looking up, you want to get catch up on any security. What I just did is clicked on resources. Down here at the very bottom, there's symbol tag, and type in CVNA. Do it fast, and it'll skip to the whole thing. Otherwise, if you type slow, you're going to get the C. All right, so there's everything on Carvana. So it's tagged there. They're all in chronological order. We've had it. I've been trading this one, actively. We've had several swing trades. More hits than misses. Last previous one was a miss. I'll show you that. No, actually, I take that back. But let me do this. Let me go back to that post and give Mike or whoever is interested the link. If I can get in there, Carvana, and there's the link to all posts on Carvana so you can see the updates. And we go back to it. So we had this trade here. There was an island top there. I gave you a total. I think I had 3 targets. We hit T1 here. We hit our first, second target. So again, whether this trade, and this is why I used to, way back when I started trying to track the performance, but I give multiple price targets. I give multiple entry points on a lot of trades, and everybody's different. Some people like to shoot for the shallow targets. Some traders will take partial profits as each target's hit. Some will hold out for the prize, meaning the final target. Some take the first initial aggressive entry. Some take add-on to a position, and therefore it makes tracking performance impossible with not an infinite but a large number of different entry points and profit-taking points on top. But either way, that went on, and it was also hit at the 200-day moving averages. Then we went and took out the that stop on that trade here. So again, I think I only had one more target at that time. I'm not sure. You'd have to look back. I know those first 2 were hit. Then in the last few updates, I gave you several updates, said the next sell signal would come here, and I gave you a new price target right here, and that was hit. So now already we triggered the sell signal here, hit that target today, earlier, when I got that chart out to Mike, 14% profit on that, and now we've taken it out. And you can see I added, updated the targets there, and this is one of my favorite trades for the year. I think there's a lot of meat on this bone. I'm going to tell you, it's not 100% contingent on my market call being correct, for a bigger drop, but it is largely contingent. In other words, if we start to get a real, we start to take out some of the, let's just say we take out the 200-day moving averages in that T2 level on QQQ, I will most likely be adding additional targets to Carvana. This is what I see when I look at the long-term chart of Carvana. I'm going here, weekly chart. Back here on the weekly time frame, again, my swing trading long-term time frame, sometimes these lines disappear. There's our beautiful bearish horizon wedge, divergent high, 200-day moving averages all broke there, 81% drop off that divergent high. Next thing, we set almost an identical thing there, nice clean up trend line, divergent high broke down there, and the stock dropped 99%. You would have lost virtually all your money in Carvana. This company, I do believe, Hindenburg will be correct. Hindenburg, before they shut down, this was one of the last calls they made. Hindenburg Research. There's a lot of I've read a lot about this company. I think there's a lot of shell game going on in the accounting. That's just me. I could sit here all day long and tell you about other reasons, but I ultimately trade off the charts, and this is the biggest divergence we've seen ever in the stock. And divergent high one, these were my long-term weekly targets I gave you back here off this divergent high. We hit the first one and we bounced as expected. That's why multiple targets, the reaction. It's a marginal new high. So I haven't changed. These are still the next targets. So if hit, and what's happened since then? Well, we took out this yellow uptrend line. Nice breakdown, back test. We're rolling off it. There's the rejection I like to see off a back test. And so if hit T2, the next target, we already hit T1, so the next drop would be to T2. 74% profit from the or drop from the recent highs, 79, and then if that fourth and final target hit, that's going to be an 88% drop. How do you trade that? How do you manage it? Well, you can trade off this weekly time frame, and if so, you'd now want to stop above those highs, or if the uptrend line is regained on a weekly closing basis, right? Same thing with a pop over the highs. You want to use weekly stops. That's my preference. Daily chart right there. Well, this was your recent sell signal on the breakdown there. So your stop, at this point, look, you just hit T1 for a, what did I say? I forget what I just said, 18, 15, whatever it was. No, right here. I'm just ballparking it, guys. 13, 14% profit. No reason to turn a 14%, let it turn into a loss. So at minimum, a stop at entry, or you can see resistance right here. I think that's a good stop, a little bit over that, maybe on a daily close over about 450. And then let it run. Let it run. There's a lot of potential in this one. And again, the broad market, it's now a component of the S&P 500, I believe, as of a few months back. So, if the market goes up, it does get that passive bid. Money going in, every dollar goes in the S&P 500. Each component gets a share of that. It's a market cap weighted share, but it's typically a net tailwind for a stock when the index is rising, if they're a component of that index. And remember, guys, don't forget how powerful it could be when that goes the other way, and it will go the other way. For those of you who believe that the Fed's finally got it all figured out, they're cutting rates and they're going to quantitative easings back and all that good stuff. Make no mistakes about it. The technicals come first and foremost. I'm going to do a video when I get back on fundamentals, only on fundamental analysis. I have a lot of charts I want to cover with you guys as we start off the year. Things to watch, both current developments and things that have already happened, and as well as potential developments, things to watch for. All right, next up, where am I at? It's Carvana, Rocket Lab. Did I cover that one already? It was written down before Carvana, RKLB. Buddy of mine asked me about this today. Nice setup. That's why I wanted to share it. So what I see on Rocket Lab is this uptrend line right here is your primary uptrend line, comes off the August of 2024 lows. Make sure you're using log scaling. If not, your charts are not going to look like mine. And you're doing yourself a huge disservice, because a stock on this time frame that I'm analyzing, when it was here, it was $4, and up here it was 80 something dollars. Okay. If you're not using log scaling, if you're using arithmetic, aka linear, then this is what your chart's going to look like. And it's not going to be the same, and it's just not representative. Log scaling puts every candlestick, puts the size of the candlestick in equal percentage terms. So if you have a big green candle like this here and a big green one there, it's the same percentage move, but not dollar move, because it's a huge difference on a $4 stock that goes to $5 versus a $60 stock that goes up a dollar, right? Okay, so bottom line is, in a nutshell, divergent high, sell signal on a break of the primary uptrend line. And you went down and you had a nice correction. It might not look like much, but from that sell signal there, it was a drop of about 30%. Hit the 200 days almost perfectly, and price support, which is also now a target, and went up to back test and has rolled over. Now I have a minor uptrend line in which to trigger the next sell signal. And this is S1, or what I call a BOD, benefit of the doubt support level at about 62.57. My first target would be 53.90, then 39.35, which will probably just undercut the 200s briefly. And then you can see if we get a real correction going in the stock market, this is a potential final target. Right now, current preferred, if we're just getting a correction, we're going to come back here. And that's going to give you, if we break down from where we're at, about a 40% or so drop to that target right there. All right, but it's what I call a trade setup, right? I mean, you could make a case to objectively short it here because it's a breakdown and a back test followed by rejection. But you have trendline support, which is just under. Wouldn't make sense for me to short right now because it's just it just needs to drop a little bit to break that trend line. Then that's a sell signal. I don't like to short on support. I like to short a break of support or a rally back into resistance. Those are my two preferred times to short anything. All right, Treasury bonds very quickly because rates do matter. TNX is the yield, the 10-year Treasury bond yield. As I've commented on many times, the Fed has lost control of the long end of the yield curve. They started a rate cutting cycle a year before this one. I don't have all the lines here. I'll show it to you on the 30-year. And it was a WTF moment for the Fed. They cut rates, and instead of long-term rates going down like they always have, and everyone thought they would, except us. Remember, we went long. We shorted the long bond back then, and gave you targets. You know, and this is the yield. You don't trade the yield. You trade the bond. The bond goes the other direction. And they went up. They cut again a little. They went up a little blip, but then up again. Third rate cut, they went up, and the Fed said, what the fuck's happening here? We need to back off. Something's going on. The market is telling us that if we keep cutting and being easy on short-term funds, it's going to create inflation and long-term rates are going to go up. So they cowed down. They stopped that rate cutting cycle, and then they fired it back up a year later on September 17th of this year. And so far, not the same outright, rejection from the market. However, with 3 rate cuts, there was another here, and then here recently, rates haven't budged. And what we have is a nice, clean trading range, as I've been covering you with TYX, the yield on the 10-year. The 10-year is probably the most important bond if you're only going to track one out there. I like to track the long bond as well, the 30-year. But this is what mortgage rates tend to track closer to, the 10-year bond, even if they're 30-year mortgage rates. And I expect, because of this positive divergence, an upside breakout. If that happens, that's going to be net bearish for the market, stock market that is. But it hasn't broken out. And all I can tell you in a trading range, you can, we're at resistance. And as I like to say, resistance is resistance until it's taken out. We have a long on Treasury bonds now, if you're interested, because we're at resistance, meaning if the 10-year and the 30-year back off, the MO, you at the top of the range, you go to the bottom. You go long, and then you go to the top of the range, and you short, buy the bottom, sell the top, buy the bottom. However, no trading range lasts forever. This one's getting ripe for a breakout sooner than later. Again, this would be obviously cause the yields to go up, bond prices to go down, and the stock market most likely to go down. So watch that level. It's very simple. That's about a 4.2% yield on the 10-year. And then TYX is the 30-year bond. Very, very important bond as well, in my opinion, especially to the government, our borrowing costs. There are the 3 cycles. They cut, Fed cut, realize, it's not happening. What's going on here? Market didn't like those cuts. The bond market, the bond vigilantes showed up. And this time around, they cut there, they cut here, and they cut here. And you can see rates have been more slowly but steadily creeping up since they've embarked on this latest rate cutting cycle again. More and more, much more importantly, guys, is this level right here. As I've covered many times, if we break out above there on the 30-year bond, I'm going to go to a monthly chart. That's going to take yields, interest rates, at least on the long end of the curve, back to levels not seen since the 90s, since the dot-com era. That's the 1990s right there, late 90s. Here's the early 2000s. And there's the financial crisis. They kissed that level there. And I'll eat my shoe if the Treasuries, the 30-year breaks out like this and the stock market doesn't take it on the chin. All right. I can't guarantee anything, but I can tell you this is my preferred scenario. It meshes with what I see in the charts on the stock market. But again, it hasn't happened, and I'm going to repeat myself again. Resistance is resistance until unless taken out. So when I go back to a daily chart or a weekly, you can see, that's the top of this trading range. That's resistance. So I have it as a circle, but that's really the trading range. So just watch this, watch the 10-year. And even if you have no desire to trade bonds because they're boring and they hardly move at all, even though you're supposed to up your position size because of that, lower gain and loss potential. But even if you have no desire to trade bonds, it does matter or will matter to the stock market. Right now, it hasn't done much because they've been moving around sideways for a while, but we're within spitting distance of breaking out again to multi-decade highs in yields. And I can all but promise you that will put the brakes on the bull market. All right, that's that. Something to watch. And we're not at imminent risk of breaking out. We've got a little bit of room to get up to those highs, but we are at risk of breaking above this down. Well, actually, we've broken out. This is the downtrend line off the highs right here, right? Got 1, 2, 3, 4 clean reactions, and so far we're breaking out there as we start the year. But the 10-year is capped right now at the top of its trading range, so it needs a little more lift here. In the 30-year, really you see a few breakout attempts, and so this will do it. All right, guys, what else did I tell you? Oh yeah, on a related note, somewhat related note, as you know, I started covering the BDC last year, the business development companies, business development ETF. It's private credit. We took out that level I was harping on as a sell signal and a risk to the equity or the credit markets, the private credit markets. Hit 1, 2, all 4 of my targets, fourth and final targets, which we reversed, at which point covered that short. I gave you 3 targets on the long side to bounce, but when we hit my second target, I canceled T3 and we dropped. Didn't really do anything with it there, but then when we hit that T3 recently, I told you you could reshort it and swing it back down to those previous targets, and then we did that and we dropped. So this is it. So I'm watching private credit still wobbling. You have a stock market right off or near all-time highs, yet private credit. And again, for those of you, if you're not familiar with the equity markets, if you know anybody in finance, especially in capital markets, ask them if credit and bond rates matter to the market. And they will tell you, oh, absolutely, more than anything. So watch that. It's lights out if we take out T4. I'll do my fundamental analysis post when I get back next week. I saw at the end of the year a couple nice big bankruptcies coming through, at least 1 or 2 that I saw are going to result in big hits to private credit companies. Again, these private credits, which they're in bed with the private equity. A lot of them are, same companies as private equity companies. And, what I'm trying to do is always looking for where the next cracks may come from, in anything, whether it's the stock market or anywhere else. So watch that. Watch the financials, XLF. I'm not going to get into that now. I've covered that quite a bit recently. Again, I got to get on the road here. I'm going to cover Bitcoin real quick for you. Bitcoin, I told you I still believe we're probably going here before all said and done. My preferred downside target zone. This was our primary uptrend line break. This is IBIT, one of the most popular, most liquid of the newer Bitcoin ETFs, spot Bitcoin ETFs. And broke down right here, and these were upside bounce targets. So that was a sell signal there. We dropped, but then I got bullish on Bitcoin here. I gave you a total of 3 targets, 1, 2, 3. But when we hit T2, just like I did on the BDCs, unrelated to Bitcoin, of course, but on the BIZD, I did the same thing. I removed T3 when T2 was hit, stating that I think that's it, or at least the risk reward wasn't there. And so far, that was it. So we milked every penny of that bounce off the bottom. It's been chopping around sideways. And more recently, I said, look, there's a downtrend line here. I can see I don't have strong convictions on it right now. If I had to be long or short at the moment, you put a gun to my head, I'd be long at the moment with stops somewhat below. Why? I have a theory. I don't know if it's going to pan out, but I think gold and silver may have topped at least before a sizable correction. If so, I think there's a lot of money that might rotate the same mentality, those gold bugs and those that are now just silver, more momentum trade, but Well, following gold, those same folks that are buying gold because they you know believe that the federal, both the Fed, the U.S. and all other countries are just debasing their currencies, going to keep printing money, and so it's a way to get away from the fiat currencies. Well, if there's a correction in gold and silver, money comes out. I can think of no better home again with those people with that mindset. And look, the logic is there. I'm not arguing the logic. But they may rotate into Bitcoin, especially since it's beat down. Again, convictions aren't high. All I can tell you, it's in this sloppy, choppy trading range. This is what I like to do sometimes, is get in, instead of hitting home runs, hit a single or double, get out, stand aside, wait for the charts to set up. So I'll continue to monitor and update this. Again, near term, we did take out the downtrend line recently. And, the logical targets would be the same targets I gave you before. If we get up to T3, that might be a nice area to short. This would be my max bounce target up here. But I'll just have to play it by ear. I don't see enough of the charts. It's not my kind of bottom. This is a sloppy looking, so I don't think it's the bottom. I think as any rally starts to look and feel good, I think the bottom, they'll do a rug pull and send Bitcoin down to here. If so, in the chart, if the charts confirm at the time, maybe we get a divergent low, something like this. I'd like to see that. Just one of many scenarios, come down, boom, and then buy it there. All right. So that's it, guys. Let me wrap up again. I think oh, no, I didn't. Sorry, one more. There was one more from a subscriber asked me to update UNG and then a handful of stocks. I'm going to cover those right now. Okay, UNG has just been sloppy as hell lately. I haven't seen anything like this. We had, we've hit it. We keep getting in these divergent lows. We hit these, this is the daily chart. We hit my first from this divergent low, or that one. First and second target, got halfway to T3 and saw a reversal, the likes of which I haven't seen in a while. Natural gas is inherently volatile, but as I showed you, I took a measuring tool and the scope of that drop was unprecedented. So there's something going on there that I'm just not sure what it is. I wouldn't put it above market manipulation. And so my convictions aren't as hot. But what I can tell you from a charting perspective, look, we keep firing off. We did it here too. Remember, divergent low, and we had a pop there. We went long. Another divergent low, wobbling. Finally, that divergent low did the trick. And we had a rally of about 100% before, and probably more in natural gas futures. Another divergent low. And so this previous low right here and any new low anytime soon will still be a divergent low, setting the stage. So I still am longer term bullish. I still maintain these targets. It's still an active trade, if you will, because we didn't, if you're targeting T6 and you went long here, anywhere in here, you're talking about a 100% upside. And so a nice 3-to-1 RR alone would give you about 20, what is that, 33%, a 33% stop loss. And you might say, Randy, that's crazy. Why would I risk 33% on anything? Because you beta adjust your position size. Anything that you're looking at making potentially 100%, if you're going to use an attractive risk-reward ratio of, let's say, that 3-to-1 RR, you don't need to put a lot in it, because if you make 100%, you made a ton of money. So you take on a security like this, maybe a quarter or a third of what you might normally trade on, let's say, SPY, the S&P 500. Therefore, a 33% loss in percentage terms sounds high, but in dollar terms, you're not losing anything more than you might on a 10% or 8% stop loss on the S&P 500, right? That's what I call beta adjusting position size. It's all right here. If you go to resources, I explain it very clear, frequently asked questions, trading related questions, and what is beta adjusted position sizing. It's all explained right there. So, and I have to say this because I got a comment last week about, or earlier this week, about getting killed in silver after we entered that trade. Again, I made it very clear. It was a fractional position when we shorted right here on the 29th. Made very clear, only a starter position. That to me is a quarter to no more than a half, usually a quarter to a third on a starter position. And it's silver. If you've been watching silver, silver's been going up 5 to 10+% a day lately. That is super high volatility. That's like natural gas movements. Therefore, you don't put as much in silver as you put in a 30-year treasury bond trade. You put a lot less in it. Because if your targets are hit, you're going to make a lot. And if your stops hit, you're going to lose a little more in percentage terms. So just adjust that position size down. And I've learned that also psychologically helps you stay in the game and ride out those 8, 9%, 10% kickbacks as long as the charts haven't changed. So that's that. Okay, and finally, I almost forgot, but I'm going to get to you. Somebody asked about a flurry of individual stocks related to natural gas. I'm looking for it here. There's a Carvana. Nope, not that one. Must be the one before. And I'm going to get to that real quick. I have to see those. I already looked at the charts. It's just more efficient for me to cover it this way. Here we go. All right, I just showed you UNG. Again, I can't, right now I can't make a hard case to buy because there's no breakouts, and nor we're at the lows. We're near the recent lows, so you could buy around support. Keep it light. But let me cover these tickers. Let me write them on my pad here. FCG, RRC, AR, and ET. Okay, I'll do this and we will wrap this video up. FCG, First Trust ISE Reserve Natural Gas Index Fund. There's an uptrend line. You can buy pullbacks to that uptrend line with a stop somewhat below, although I'd use a stop below this price support about 22.70. I'd encourage you to freeze this, just pause the video and you can replicate the chart. Again, use log scaling. So you're in a big, what we call in technical analysis is almost symmetrical triangle pattern. It's definitely a triangle pattern with an upside break, especially over this BOD, what I call benefit of the doubt, resistance level 25.70. By the way, these are all price targets. So right now, you're coming off this uptrend line. You're still close enough. You can make a case to go long anywhere in here with stops below there or a maximum stop somewhat below that 2184 support. That should be ugly if taken out. Swing it up to the top of the triangle would be my minimum swing target, and an upside break of the triangle, especially, so maybe a starter add-on if you break above the triangle, and then that 25.70, and that would take you up towards these previous highs right there. Obviously, you're going to want to see natural gas acting well at the time. RRC, Range Resources. You can see my chart here. I have two trend lines. This is the primary, and then I have this little what I call BOD, benefit of the doubt. Why is that? Because it captures these two little spike lows through there. So that's the lower of the two. Plus it comes in with price support. So this is, as long as this stock holds above this level here, about $33 in that uptrend line, looks good. Any break below there is bearish, in my opinion. Puts in these series of divergent highs and then corrects. It's a great swing trading stock. Just look at divergent high, divergent low, divergent high, divergent low, divergent high. All right, you get the point. No divergent low, but either way, this is a divergent high. It's corrected close to. It's got a little more downside to support here, but it's in an uptrend. If you just take a step back, and that's what, if you recognize anything's in an uptrend, if you believe that uptrend is going to stay intact, uptrend's simply a security making higher lows and higher highs. That is the definition of an uptrend. And what you do in an uptrend, you buy pullbacks to support. All right. And then you have your stops, as I mentioned, below those support levels, because then you may have a trend change if and when that happens. AR, Antero Resources. Also nice clean uptrend line, recently put in a divergent low, rallied there. And again, it swing trades very well to the technicals. Divergent high, trend line break and back test, get out. Or short it. Divergent low, start covering those shorts, go long. Divergent high, followed by a trend line break, drop down, put in a that was the first divergent low and it rallied. Put in another second and still marginal new divergent low. And it's been in an uptrend since. Uptrend, higher highs, higher lows. I don't have a, entry points would be right here. 32.26 would be, if you get it. You may not get it because we're already coming off that divergent low, or pull back to that uptrend line. Those are objective long entries with stops somewhat below. Last one, ET. Energy transfer equity looks to be in a falling wedge or a descending triangle pattern. Put in that divergent high right here. That was a get out of Dodge moment right there, and it had an uptrend line. I didn't have it drawn, but there it is. Broke that uptrend line, back tested it, went down. There's your downtrend line right now. Divergence line. Okay, positive or bullish divergence. So if it pops that, 17.13 first target, 18.18 second target, 19.12, 19.95. If it continues lower, which it could, it will continue to diverge. That would be your first support, 15.80. Next support around $15 right there. All right, guys, I'm going to wrap it up here. Again, Happy New Year to everybody. I've got to shut down for the day, be back this weekend, and I will most certainly start the week firing out a lot of trade ideas, new trade. I'm always looking for new trade ideas, but let's see how things go today, and then I'll start on Monday with a new update, including fundamentals. I got a lot of charts I want to show you, economic charts, kind of give you an outlook of what's going on right now and what to look for going forward. This has been Randy Finney with Right Side of the Chart. Have a great day.